There's a script we've all been handed, preached by parents, reinforced by real estate agents with their faces on billboards, sold to us as the ultimate marker of success, the American dream. The golden ticket to wealth and stability. The script says, rent is throwing money away. You're building your landlord's wealth instead of your own. Buying a house is the smartest financial move you'll ever make. We internalize this so deeply it becomes part of our identity. We feel genuine shame if we're still renting at 30. We failed to launch. We're financially incompetent children who refuse to grow up. So we panic buy houses we can barely afford, stretch our debt-to-income ratios to the breaking point, convince ourselves we're making a brilliant investment simply because we signed a deed. But I'm here to tell you something that's going to make a lot of people uncomfortable. For millions of people in the modern economy, this script is a complete lie. The math has changed, the market has changed, and blind faith in homeownership is trapping an entire generation in financial prison. The uncomfortable truth is this. For many of you watching, your house is not an asset, it's a liability. It's a massive leverage-fueled consumption purchase masquerading as an investment. My name is Mike, and I spend way too much time running numbers that the real estate industry desperately hopes you never see. If you feel pressure to buy, or if you're currently house poor wondering why you don't feel rich despite owning a home, hit that subscribe button and smash the like. Today, we're dismantling the rent versus buy myth piece by piece. We're exposing the unrecoverable costs of home ownership. The money you throw away that's mathematically identical to rent. We're calculating the price-to-rent ratio, the single most important metric for this decision. And I'm going to show you how a disciplined renter who invests the difference can end up with higher net worth, more freedom, and less stress than the homeowner chained to a 30-year mortgage. What throwing money away actually means to understand why buying isn't always better. We need to redefine what throwing money away actually means. When you rent, you pay monthly for a roof over your head. That money is gone, this is obvious. Everyone understands this, but when you buy a house, you're told your monthly payment is savings or building equity. This is false. Especially in the early years, a massive portion of your monthly housing cost as an owner is also thrown away. Money that never comes back, money that builds zero equity. We call these the unrecoverable costs. And they're silent wealth killers. First, mortgage interest. In the first years of a 30-year mortgage, 70 to 80% of your monthly payment goes straight to the bank as interest. You're not paying yourself, you're renting money from the bank. Look at an amortization schedule. It's terrifying. You might pay $3,000 monthly and only $400 actually reduces your debt, the rest? Vapor, gone forever. Second, property taxes. A perpetual rent you pay the government for the privilege of existing on your land. In high-tax states, this alone equals a modest rent payment. Third, maintenance. The rule of thumb says 1 to 2% of the home's value annually. This isn't fun renovations, it's unsexy stuff. Water heaters, roof repairs, HVAC replacements, foundation issues, pest control. Fourth, homeowners insurance, which keeps getting more expensive as climate risks increase. Fifth, transaction costs. Buying and selling can consume up to 10% of the asset's value. Just to change your mind when you add all these up, interest, taxes, maintenance, insurance, fees. You often find the unrecoverable cost of owning is nearly identical to, or even higher than renting a similar property. You're not building wealth. You're just paying a different landlord, one comprised of the bank, the state, the insurance company, and Home Depot. The price-to-rent ratio, the number nobody talks about. The math of this decision comes down to one critical number, the price-to-rent ratio. This is essentially the PE ratio of the housing market. You calculate it by taking the home price and dividing by annual rent for a similar property. If a house costs $500,000 and rents for $2,000 monthly, $24,000 annually, the ratio is roughly 21 historically. A ratio below 15 suggests buying makes sense. A ratio above 20 suggests renting is arguably better. In many major cities today, Toronto, San Francisco, New York, Seattle, Austin, ratios are pushing 25, 30, even higher when the ratio is that high. The math screams at you to rent. Why? The cost of capital on that massive purchase price far exceeds the cost of rent. By renting, you're effectively shorting the housing market. You're living in a $1 million asset for a fraction of what it costs to finance it. You're letting the landlord subsidize your lifestyle while they take on all the risk. The boiler breaks. Their problem, foundation cracks. Their problem, market crashes. Their problem, you're consuming housing services at a discount while the owner speculates on appreciation that may or may not happen. The invisible wealth killer, opportunity cost, but the most dangerous trap of homeownership is something nobody talks about at dinner parties: the opportunity cost of the down payment. To buy that $500,000 home, you need to put down $100,000 at 20%. That's $100,000 of cash now locked in a wall. Debt equity, it produces no cash flow, can't be used for groceries, can't be rebalanced, it's trapped. If you had invested that $100,000 in the S&P 500, which historically returns about 10% annually, it would double roughly every 7 years by locking it in a house. You're placing a massive bet that your single, specific, local real estate market will outperform the diverse global stock market. Historically, that's a losing bet. Robert Shiller, Nobel Prize-winning economist, proved that over the last century, real home prices have barely outpaced inflation. The massive gains people talk about are usually just inflation illusions or leveraged luck in specific bubble markets during specific decades. By renting and investing that $100,000 down payment, plus the monthly difference between rent and ownership costs into the stock market, you maintain liquidity, diversification, and higher expected returns. This is the rent and invest the difference strategy. For disciplined people, it's a wealth accelerator. It turns you from house-rich, cash-poor prisoner into a liquid millionaire. The mobility premium. We also need to talk about liquidity and mobility, which are massively undervalued in the modern economy. Your house is an anchor in a rapidly changing world. The ability to move for a better job, lower cost of living, or better lifestyle is a huge financial asset. You get a job offer in another city paying $50,000 more. The renter packs up and leaves in 30 days with minimal friction. The homeowner is trapped. They have to sell the house, pay 6% in agent fees, pay closing costs, stage the home, hope the market cooperates, potentially sell at a loss if timing is bad. The transaction costs of selling can wipe out years of accumulated equity in a single afternoon. By buying, you're essentially shorting your own mobility. You're betting your current location will be the best place for you for 7 to 10 years minimum. If you're wrong, the exit fee is brutal. Renting buys you optionality in a volatile world. Optionality has premium value. The ability to pivot is worth something, even if it doesn't show up on a spreadsheet, but rent goes up. My mortgage is fixed. I hear the objection, the one everyone yells. But Mike, rent goes up every year. My mortgage payment is fixed. This is true. It's the single strongest argument for buying. A fixed-rate mortgage is indeed a hedge against inflation. But remember, while the mortgage is fixed, nothing else is. Property taxes go up constantly as municipalities need revenue. Insurance premiums are skyrocketing due to climate risks. The cost of materials and labor to fix your roof goes up with inflation. You're not immune to inflation as a homeowner, you're just exposed to it differently, and while rent does increase, so does the stock market. If your investment portfolio, funded by renting savings, grows at 7 to 10% annually, it will likely outpace the 3% average rent increase. You're using appreciating assets to pay for your lifestyle rather than using your lifestyle, your house, as your only asset. The gap between investment returns and rent increases is often where the renter wins financially. The lifestyle cost nobody calculates. There's also a profound lifestyle element that gets completely ignored in spreadsheets. Homeownership is a part-time job. It's weekends at Home Depot instead of with friends. It's stress from hearing weird noises in the basement knowing you have to pay to fix it. It's the mental load of managing a deteriorating physical asset. When you rent, you're outsourcing that stress. You're buying time, dishwasher breaks. Call a number, it gets fixed. No parts to research. No contractors to vet, no time wasted. That time freedom has real value. If you use those Saturday mornings to learn skills, start a side hustle, or just recharge. You might find renting actually increases your income potential. You're not distracted by house maintenance. You're trading the pride of ownership for the luxury of freedom. Many people buy thinking it will give them stability. Instead, they get anxiety, financial stress, weekend stress, relationship stress from disagreeing about renovations. When buying actually makes sense, look, I'm not saying you should never buy a house. Buying makes sense in specific scenarios. If you're settling down for 10 plus years minimum, if you value customization ability more than liquidity, if the price to rent ratio in your area actually favors it, if you have stable dual income and significant emergency funds, if you genuinely want to manage a property, but don't buy because you think it's mandatory for wealth. Don't buy because you're afraid of throwing money away on rent while ignoring money thrown away on interest and taxes. A house is a consumption choice, like a fancy car or expensive watch. It's a place to live, not a guaranteed retirement plan. If you treat your primary residence as your primary investment, you're creating a highly concentrated, illiquid, expensive portfolio that's one natural disaster or neighborhood decline away from financial ruin. The real path to wealth, the path to wealth isn't about owning a deed. It's about owning income-producing assets, stocks, bonds, businesses. These are assets that pay you. A house is an asset that you pay. Think about it. Your stock portfolio sends you dividends. Your rental property that you don't live in sends you cash flow. Your business generates profit, your primary residence. You send IT money every month forever. Even after the mortgage is paid off, you're still paying property taxes, insurance, maintenance, HOA fees. It never stops taking money from you. Don't let cultural script bully you into a bad investment. Run the numbers, check the price to rent ratio, look at unrecoverable costs. Calculate opportunity cost of that down payment. And if the math says rent, then rent with pride. Invest the difference. Build your liquid empire. Let the landlord worry about the roof. The real trap. Here's what the real estate industry doesn't want you to realize. They make money when you buy. Agents get 6% commission on the sale. Mortgage brokers get paid when you finance. Banks profit from 30 years of interest payments. Nobody in that equation makes money when you rent and invest in index funds. That's why the script is so aggressive, so pervasive, so emotionally charged. They've convinced an entire generation that renting is failure. That homeownership is success, that a deed makes you wealthy. But wealth isn't about what you own, it's about what owns you. The homeowner with a $500,000 mortgage and $100,000 equity is less wealthy than the renter with $200,000 in liquid investments. One has options, one is trapped. The homeowner can't move for a better opportunity without massive transaction costs. Can't pivot careers without risking the mortgage payment. Can't take entrepreneurial risks because the house payment looms, the renter with investments. Total freedom can move anywhere in 30 days. Can take career risks knowing their portfolio generates passive income. Can wait out market downturns without panic. That's real wealth, freedom, optionality, flexibility. Your move, so here's what you need to do. Calculate the price to rent ratio in your market right now. Be honest about it if it's above 20. Seriously consider renting and investing the difference. If you already own and you're house poor, run the numbers on whether selling and renting actually improves your financial position. Consider what you're giving up by having all your net worth locked in a single, illiquid asset in one geographic location. Ask yourself, am I buying because the math works? Or because I'm afraid of what people will think if I rent? Because if it's the latter, you're making a $500,000 decision based on social pressure. That's insane. Your 30-year-old self-renting and investing might outperform your 30-year-old self-buying and house poor. Not just financially, but in quality of life. Stress levels and actual freedom. The American dream was sold to us in a different economic era. The math has changed, the rules have changed, but the script hasn't. Don't be a slave to outdated wisdom. Run your own numbers. Make your own decision. And if that decision is to rent and build wealth through liquid investments, own that choice, because in 10 years, while your homeowner friends are still house poor and stressed, you might be sitting on a 7-figure investment portfolio with total geographic and career freedom. That sounds a lot more like the actual dream to me. If this video made you rethink the biggest financial decision of your life, subscribe to the channel. Drop a comment. Are you renting or buying, and why? Let's have an honest conversation. Thanks for watching, and I'll see you in the next one.